I want to shift back over to the broader market here, though, maybe away from digital currencies, back to stocks, as we have seen the NASDAQ outperform on the day, maybe potentially juicing the idea that some of these tech stocks, the growth stocks that had previously been the growth engine of us reaching all-time highs, back in favor potentially over the next couple months. And for more on that, I want to bring on Marko Papic, Clocktower Group Chief Strategist, here with us today. And Marko, when we look into it, obviously the inflation trade kind of sparked a bit of a pullback in those growth names. But now, as we've seen the yield on the 10-year come back down below 1.5, talk to me about what you're seeing there in terms of opportunities for people to lean back into maybe some of those FANG names now.
This is probably the greatest debate in the macro universe right now, which is whether the reflation trade has any more legs. Should you be in cyclicals, value, commodities, EM, or is it a moment for growth stocks, tech stocks to really outperform long term? And look, that trade has worked so well for most investors for the past decade. And so it's difficult for them to get away from being drawn to it. And I do think that there's this interregnum, this sort of like cyclical mini hiccup in growth that's coming up. And it's really a combination of upcoming fiscal cliff, which will be significant, perhaps largest since the Korean War. You have the problem, the handover from retail sales to services, and you have generally just concerns that the current pace of growth won't be kept up. And that has given a bid to bonds, brought the yields lower, and definitely given growth stocks a little bit of a kick in the rear.
What does that fiscal cliff you're talking about look like? And ultimately, what does that mean in terms of positioning?
So the fiscal cliff has been known really since the fiscal stimulus earlier this year was passed. It's about 4 to 6% of GDP. Now that's very significant. And there's no way to avoid it, not even if we pass infrastructure spending bill or two. And that's because the infrastructure spending bills will spread out government spending over a course of several years. So there will be a rate of change, a mathematical fiscal cliff. It's not a policy fiscal cliff. It doesn't mean that the government is actually implementing austerity, far from it. It's just that next year's spending has no chance of keeping up with this year's spending. And that will be a headwind to growth.
Yeah, when we talk about what the global picture looks like, particularly in back up, I mean, we focus in a lot on the U.S. quite a bit here, but when you back up and look at other economies around the world, interesting to see you talking about the Russian ruble here. Not a lot of our guests talk about that, but I mean, how do you fit the context of what we're seeing play out here in the U.S. into the global picture and what it could mean and what investors should know about it?
Well, I think that also contributes to this kind of an interregnum because most investors are just not sold on the idea that the rest of the world is ready to keep up, to open up. So you have a lot of conversations in the macro universe, for example, about Chinese deleveraging, about total social financing coming down. There's a lot of concerns about Europe and whether they're really willing to open up with the new variants of COVID-19 and so on. And what I would say is that this is all fair and this is all right. It's just if you step back and you look at an asset like the ruble has been plumbing lows, even though oil prices have rallied. And there's part of that is geopolitical risk premium. Part of that is just a level of concern about emerging markets that continues to permeate even from last year. And so I do think that's a source of alpha over the next 6 months as an asset. But broadly, I would say that investors should not fall in love with this interregnum, with this period of outperformance by growth. And that's because although there are some intra-cyclical hiccups in growth that we all kind of understand, the fact of the matter is that the Fed is probably already far beyond the curve, far behind the curve. And that's because this cycle does not have the headwinds to growth that the last cycle had. The household deleveraging, the persistent austerity, and the balance of payment crisis in emerging markets in Europe.
Even with that said, it sounds like you think there is a brief window here of opportunity for growth stocks. And what's interesting in your notes, you're not necessarily look at sort of the traditional tech names we talk about. It sounds like you see real opportunity on the renewable energy side. What do you see that you like?
Well, first of all, I'm really biased on that question because I just think that green tech and sustainability is going to be like a decade-long thesis. We've produced a lot of research on that front. So we're always looking for opportunities in that field, in the growth space. But Specifically on solar stocks, they have Chinese stocks tend to lead those of other countries, including the U.S. Chinese stocks have been rallying. The solar names have been rallying for several months. And so we think that there is a moment of opportunity, a window of opportunity for tech plays in that field.
That's going to be interesting to watch. We'll be discussing a little bit more of the solar plays coming up later on in the show. But for now, Marko Papic, Clocktower Group Chief Strategist, appreciate you coming on here to chat with us today.